Hi there, I'm Matthew Lester from the Rhodes Business School. I'm also a member of the Davis Tax Committee. The Financial Planning Institute has asked me to give a little paper on what I think is happening with trusts and estate duties. This I've presented on 26 June 2014. Anybody can share in this presentation, but I can warn you up front that I'm not going to give away too much about what we are discussing at the Davis Tax Committee at this stage. So we start off with how's it, who's it, where's it? Where do trusts come from and what are we doing with them? Well, the basic idea of a trust is that we have a donor with a problem, got too much money, I want to get rid of it. So I create an instruction or the trust deed and I find a stooge or a trustee to look after it, and that money is then applied for the use of a beneficiary. The beneficiary is different from the donor or can include the donor. We also have a little implication we have to deal with here, is donations tax on forming trusts. This is generally solved by granting a loan from the donor to the trust, and that also provides an element of control over the trust, because not only are we a trustee, we're also a creditor of the trust. Now, when we look at the initial obvious advantages of this, we have succession planning. When we die, the trust doesn't die, and my funds are then looked after by the stooge. We also have estate duty saving, but only on the extent of wealth creation after the formation of the trust. So death should have no impact on the trust itself. There are also certain income tax advantages which we have to look at. Some say a trust will save you if you are sequestrated, and others say that they can be very handy in the case of a divorce. That's why we sell them. When it comes to the basic taxation of trusts, there is the simple outline of the trust. What the Tax Act does is it first tries to pin the income back on the donor. If that fails, then the beneficiary is taxed in terms of Section 25B on income to which the beneficiary has become entitled. And then finally, if those two tests fail, then there is an attempt to tax the trust itself. Now, this has led to a little bit of an anomaly. When it comes to revenue income, a trust has a flat rate of tax of 40%. But if the income can be taxed in the hands of the beneficiary or the donor, the maximum tax rate is 40%. It may well be lower if the individual has not yet reached super tax. And when it comes to capital rates of tax, well, there the flat rate of CGT for a trust is 26.67% due to a 66.7% inclusion rate, whereas the maximum rate of CGT for an individual is 13.3%. So there's a doubling up of tax exposure potentially when we use a trust, but we can very easily cause the capital income to vest in the name of the beneficiary or the donor, and that will reduce the rate down to 13.3%. Most people can get that right, and it's an obvious tax loophole that is widely exploited in South Africa today. Then comes the issue of the non-resident trusts. In the post-war era, they couldn't get anybody to populate the Channel Islands, so they got some wealthy people to say, go and live there, you won't pay tax there, and you can start a little business as well, offering this tax-free service to the rest of the world. And so the islands of the rest of the world copied it. It created a major industry. Now, I'm not going to go into offshore trusts in much detail in this presentation. We simply say that they are there, but we have to say, will they survive? Now, when we come to estate duty itself, you've got to say that in the context of a nearly 1 trillion rand budget for 2015, we are looking at estate duty going to contribute about 1,000th of that, just over 1 billion rand per year. It's a tiny tax collection in the context of South Africa. And the obvious issue would be to say, for goodness sake, get rid of it, up the CGT inclusion rate or put it on the cigarettes or just do something, but it's not worth having because it's getting in the way. One has to ask the question, why are trusts tolerated? And to do this, you have to take a spectrum of the different taxes. They could abolish it, which would be politically unacceptable, and abandon wealth taxes completely, or they can go to the enormous extreme of bringing in higher estate duty rates or replacing the entire system with, for example, capital transfer tax. In the middle is the benign approach, which is to just let sleeping dogs lie and maintain the status quo with estate duty. And then there could be a more effective way of broadening the base of estate duty, possibly reducing the rate and reducing the exemptions. So conclusions thus far is that the use of trusts has evolved substantially since World War II. There is no specific form of a trust. We don't have a memorandum and articles, etc. So it is incredibly difficult to set up a standard basis of taxation for trusts. And trusts must be one of the most difficult targets worldwide for the revenue authorities to tackle. Will they just allow this to continue and say, well, maybe just leave them alone? And the answer to that is probably not, and it doesn't have a tax consequence. Trusts have been used to disguise the ownership of money for many years. And I think that this changed at 9/11, where we simply say that worldwide anonymous structures are no longer going to be tolerated. And 12 years later, we have now the world in a global forum for transparency and exchange of information. Notice that South Africa is involved in that. As tax systems develop around the world, we are not going to be able to simply hide behind the convenience of a trustee and simply say that's not my money. This move is growing, and then also we have to look at it socially to say socially there is an outcry against taxation planning. We had tax experts being heroes 20 years ago. Today they're the zeros that go in the back door. We don't admit to talking to them. We have to look at public outcry against tax planning. We see it on CNN every day, and the fiscal authorities are going to tackle this. We also have to take into consideration the question of inequality. And there we have a graph which is widely used by Piketty, explaining that Europe has had a lower increase in inequality than the United States. And he is saying that the way to correct inequality is through the tax system, and in principle he is saying we should be looking at wealth taxes, estate duties and inheritance tax. Now Mr. Piketty is getting incredibly popular these days on his book, and certainly this is giving a lot of political clout to saying, well, why don't we look at the whole question of wealth taxation again? In that climate, it's not to say that we're going to get wealth taxes, but certainly it's going to be very difficult to justify getting rid of existing wealth taxes, and estate duty is one of them. So we've got to say, if you've got a trust, keeping ahead of the pack is going to become more and more difficult and more expensive. For this reason, we need to say they are no longer the universal panacea for all ills. Let's look at other issues like who needs a trust. Well, when one looks at life expectancy in South Africa per the 2010 mid-year estimates, they are saying that the average life expectancy of a South African is about 53 years old. That's very misleading in the context of financial planning, because if one looks at the white population, you will notice that they have a significantly longer life expectancy than others. The reason for that is quite simply that is the more privileged population. They've had access to homes, food, medical care, etc. They haven't been doing menial work, and so they have a far longer life expectancy. When one talks financial planning, we are talking about privileged people with longer life expectancy. So we can't really look at the South African average when looking at financial planning. Of more use is to go on to the World Health Organization's website. They have got a prediction of life expectancy at 60, and for South Africans that is 16 years, i.e. average age 76 if you live to 60, and for women it is 78, 18 years post 60. And in the context of financial planning, we have to couple these together to say we have to look at the joint life expectancy of both husband and wife. So when one looks at life expectancies, we are saying, take the figures from WHO, and we are saying that in a financial plan, we have got to be saying that we're going to be looking at about 20 years post-retirement at 65, where you are going to have to fend for yourself. And that is a significantly longer period than it used to be, particularly in the case of males. So now comes the question, how much capital will you exhaust in your retirement? Because that's going to affect estate duty liability and the need for a trust. You don't want to get rid of your wealth in favor of a trust if you are going to need it in your retirement. So, let's make some assumptions here. We are saying I need in retirement a moderate amount of R1,000 per day or R30,000 per month, increasing with inflation, and I've got a good financial planner who can get me 12% annual return on average. That would mean I need a capital requirement of R6 million cash in retirement. So what we are saying is that for every 5,000 per month you require pre-tax, you should have about R1 million of capital if you want to last out 20 years. Now, this R30,000 per month excludes the car and house, which we presume that you've already got. Another way of analyzing it might be to say, I need medical cover on Discovery Health that's costing R3,000 per month now for comprehensive cover. So two people will exhaust R1 million of capital over 20 years just on medical expenses. Utility services on a small house will wipe out another 5,000 or so a month. That's another R1 million you may require. And if you want to have a servant for 20 years, that's another R1 million that you're going to require. That's R3 million of retirement capital that you're going to exhaust before you've even started living, playing bingo, and feeding yourself. So the old way that we used to look at a trust concept was to say this. The donor is the pensioner. He sets up a trust to look after himself and whatever will go on to his beneficiaries. The trustee will administer it, and the beneficiaries will be the pensioner and the family. Now that's presuming that the family are going to have something to inherit after 20 years. And from the figures you'll see today, that's not very likely. So, the estate duty computation goes as follows. Accumulate all the assets. Now, we used to prevent assets from accumulating by using trusts. This has so far gone almost unchallenged by SARS, and we can expect a tightening up of that in years to come. We also look at the issue there of the reasonable maintenance of the taxpayer and his family. The money that you spend on your kids, your grandkids, and everybody else is going up. There is an unlimited estate duty donations tax exemption on that, and a lot of people are dissipating their estates by using it. Then we take away the double tax component of CGT and estate duty on death. A lot of people see that as double tax. It's not necessarily so. Estate duty is primarily a wealth tax technically, and CGT is an income tax or tax on growth. So that's probably going to stay. And then we take out paying our creditors, and then we have to consider the insurance gap. South Africa's life insurance gap is currently in the region of 9 billion rand. Most estates have a problem that they simply cannot discharge the cash requirements of the estate. That gives you the value of the estate, and then that carries over into the next part of the computation where we deduct the abatements. That's the interspouse abatement. Now that has been changed now. You can leave as much as you want to your spouse. That's a constitutional issue because we are taxing people differently depending on marital status. And then a new change from 2008 is that all your monies received or left over in your retirement fund are also exempt from estate duty when paid on to your nominees. Charitable bequests are exempt, not that many people are using them. And then there is the 3.5 million abatement, to which can be added what's called the portable spouse exemption, the unutilized portion of a predeceased spouse estate of that 3.5 million. So the more spouses you have, the less estate duty you have, provided you can outlive them. The remaining balance is dutiable at 20%. If one takes all of those abatements, most South Africans are in a position to discharge their estate duty liability by simply leaving everything to a spouse and leaving their retirement funds plus 3.5 million rand to other people. The new way for most South Africans of structuring an estate simply works on the basis that we take the pensioner. They have a small cash portfolio. They have their offshore investments, which are difficult to hold in a retirement fund. That's your 4 million allowances plus growth. And then they have their residential accommodation. We put all of those into one box and we say we can discharge the estate duty liability on that by simply writing a last will and testament using the 3.5 million rand abatement and the portable spousal exemption and the interspouse abatement. So we have no estate duty exposure there for most. And then we have the issue of the retirement fund, which can hold as much wealth as you want, and all we need is a beneficiary nomination form there to get around estate duty. So what's the problem? Why do we suddenly need a trust over and above all of this? The abatements have gone up. We've got the portable spousal abatement. We've got the retirement fund abatement. All of these have come in over the last 20 years, and consequently your exposure to estate duty is a lot less than it used to be. So here are some closing observations. The complete repeal of estate duty, like we have it in Australia, they got rid of it in the 1970s. I don't think it's going to happen. There is a strong lobby in support of Piketty's argument for wealth taxes. But CGT is not a wealth tax, but rather a tax on capital income. That's not going to help the Piketty argument. Other forms of tax, which would be wealth taxes, such as capital transfer tax, which you have in Canada, will take years to implement and will use enormous numbers of resources in SARS. It's unlikely that we are going to see any of that sort of stuff in the short term in South Africa. But estate duty is probably going to stay and be tinkered with. And then we have to go forward and say, okay, so is that the end of the debate? No. South Africans should be aware of the fact that there are fundamentals in the current estate duty system that will obviously have to be reconsidered. The loopholes open to the taxation of trusts cannot be expected to endure forever. Many have been predicting that Section 7 and 25B would be repealed, and obviously this is again in the sights of SARS. We've also got to look at how long will we be able to continue to make interest-free loans to trusts. This was considered in the case of the Brumeria versus SARS. There were adverse consequences for Brumeria, but the principle has not really been pursued or extended by SARS since. The interspousal exemption has constitutional implications. How can we have separate taxation of husband and wife when we have joint taxation for estate duty purposes? That's just rubbish. And the retirement fund exemption may have been too generous, and it is also creating estate duty arbitrages between other forms of investments and retirement funds. Over the next 2 years, those are going to have to be considered, and we'll have to just see what happens with that. So now we have to say, in the meantime, do you form a trust? And formation of trusts really should start from a good commercial reason. Do you need a trust? Those who say, oh, well, it provides you cover against your creditors. Do you really have a risk to your creditors? Do you really have a risk of a divorce? And if so, do you really think that a trust is going to help you? A spouse does not have to settle simply because you have a trust. And some people would even say that having trust can make you an even bigger target. And then we have to ask the question, in reality, does the donor really have an estate duty exposure, or can that be managed as far as possible using the last will and testament and retirement funds? It's very important in this regard to note that if once you've formed a trust, you can't simply take it apart. Many donors get this wrong in the case of family disputes, where they say, I've lost faith in my children, I want to dissolve the trust and take everything back. Then the children run off and say, we're beneficiaries, the trustees must act in our best interests. That's a reality. And what we can't expect is that if there are changes in the taxation of trusts, that there will be a window of opportunity to undo trusts. And we've tried that before, for example, with the primary residence issue. And we find that that is not really a tax issue. It's more a commercial issue of responsibilities of trustees to beneficiaries. What we have to look at is really the four objectives that are in a modern financial plan. They are: insure yourself against the risks associated with living in the new South Africa. Create a savings portfolio to see you through the hard times. Create an investment portfolio containing your offshore investments which have a low exposure to capital gains tax. And then finally, create a retirement fund portfolio utilizing the enormous tax exemptions that have been granted to retirement funds over the past 5 years. We don't see in those blocks create an estate plan. And the reason is that for most South Africans, we don't have an estate duty problem. What South Africans do not realize is that we have completely reformed retirement funds over the last 5 or 10 years, where from next year there are tax-deductible contributions available from 27.5% of taxable income. Growth within the fund is completely tax-free, CGT-free, and estate duty-free. That has become the modern trust. If we look at it and where South Africans are going wrong with their financial planning, is that they still think financial planning is all about saving. They don't see, when one looks at interest rates and inflation rates, that the interest rate was well above the inflation rate in years gone by under the days of Chris Stultz. Those interest rates were managed downwards by Tito Mboweni, and Jill Marcus has kept that trend going, to the extent that the inflation rate is now above the pre-tax interest rate. How do you grow funds when that's happening? And South Africans are so hell-bent on building wealth within trusts that they can't see that our whole investment strategy has had to move away from savings plans to equity plans to try and keep a real growth in money. I think that that's where people have got it wrong. That's why they're poorer today, and that's why they're less happy. Because if we borrow a calculator from Stand-Up here quickly and we say, if you were building a financial plan 30 years ago, you wanted 30,000 Rand per month, inflation-linked annuity, and we said the interest rates at the time were 20%, inflation rates were 10%. If we did that, we needed about 4.5 million Rand to last you 20 years. But that's changed, because what we see today is that the investment return risk-free is about 5%, where the assumed inflation rate is 6%. If we plug that into the calculator, we see that if you're living like that, you are going to eat up all your capital in 120 months. So there won't be an estate duty liability, there won't be anything left, and your kids will inherit you and not your money. That's the big mistake that people are making. If we try to build a fund today that will last for 20 years, providing 30,000 Rand a month on a straight risk-free interest rate of 5%, we're not going to need 4.5 million Rand, we're going to need 10 million Rand. Nobody's got that. Financial planning today is about saying, well, if I can get my return rate up to, say, 10% using equities, the 10 million Rand requirement reduces to 6.35 million Rand. And if I go further and I say, increase the risk return rate by another 2.5% by combining the tax benefit and refund and reinvesting that into a retirement annuity, I might be able to get a return rate of 12.5%, which means that my capital requirement in retirement is only 5.25 million. So my summary on it is this, that if you're looking for 30,000 Rand a month, it will cost you 4.5 million Rand 20 years ago. Today, on risk-free rates, you'd pay 10 million, and we can maybe get that down to 5.25 million Rand using a well-managed investment suite and the tax benefits of retirement annuity funds. That's what financial strategy is all about today. And I think people have put far too much emphasis onto trusts. They've created far too many of them, and many of us don't need them. So we've got to say, actually, financial strategy is about using equities and a tax break and faith and time for money to grow. We might be able to create some sort of a financial plan. If we leave it to a trust, it's certainly not going to do it. So there's my little presentation. You're welcome to give me your views. There are my contact details. Thank you for your attention.